Every major market crash in history didn't just happen. It was triggered by something no headline ever warned you about. You've seen the chaos that comes after, the fear, the sell-offs, the blood in the streets. But before that chaos, there is a signal. Silent, invisible, buried so deep in the system that only the few who know where to look ever see it. And when they do, they don't wait. They vanish before the floor disappears. Today, I'll show you that signal. I'll rip it out of the shadows and put it right in front of you. And once you see it, you'll never be able to unsee it. Because here's the truth. It's flashing again. And the question isn't if it means disaster. It's how much time we have left before the next collapse begins. It never begins with chaos. It begins with a silence so deep it almost feels wrong. No sirens, no urgent news flashes, just a faint tremor buried in the data. The kind most traders wave away as meaningless static. But to the few who know where to look, it's not noise. It's the opening note of a song you never want to hear, because it always ends the same way. The signal hides where almost no one bothers to look, the yield curve. Think of it as a bridge, a delicate arc linking the price of money now to the price of money years from now. In healthy times, that bridge slopes upward. Short-term borrowing is cheap, long-term is more expensive. That's the heartbeat of growth. But when that bridge flips, when short-term money becomes more expensive than long-term, the market is whispering something dangerous. Economists label it inversion. Traders who've stood ankle-deep in spilled coffee and panic on the trading floor, they call it something else. The whisper before the scream. And history? History remembers. August 2006, the curve inverts. The story is buried in the back pages of finance sections, lost between gold prices and currency tables. 2 years later, Lehman Brothers is gone and the world's financial system is on its knees. Late 2019, another inversion, dismissed as a technical blip. Months later, trillions of dollars vanish in the pandemic crash. Go further back, 2000, before the dot-com implosion, 1929 before the Great Depression. Each time, a quiet kink in the bond market predicted a storm the public never saw coming. Why does it work? Because inversion doesn't grow out of confidence, it feeds on fear. When big money senses danger, it abandons the short-term chaos and hides in long-term bonds. To outsiders, it looks like faith in the future. In reality, it's boarding up the windows before the hurricane hits. Nature knows this pattern. Before a forest storm, the animals vanish. The silence feels unnatural. The market behaves the same way. The stillness is not peace, it's warning. So why doesn't everyone act? Because the trap is cruel. The crash doesn't strike immediately. It can take months. Prices rise again. Analysts say, this time is different. It never is. Look at the charts today. The curve is inverted deeper than it was in 2006, longer than in 2019. The signal isn't whispering, it's screaming. And yet the market keeps dancing. The party always feels safest right before the lights go out. That's the danger. The quiet before the collapse is intoxicating. It convinces you the danger has passed. It lulls you to sleep. Before we go any further, if you're starting to recognize the pattern, if you think more people need to see this before it's too late, hit the like button right now. It tells me you want these hidden signals dragged into the light, and it helps push this warning to those still convinced the music will never stop. Because in the next chapter, we open the archive. We'll place today's market beside the days just before history's most devastating collapses. And when you see how perfectly the lines match, you'll realize the past isn't gone, It's repeating. The chart turns black and white, not because the data's old, but because the moment it captures belongs to another lifetime. October 1929. The roaring 20s are still roaring. Jazz leaks from smoky speakeasies. Model T Fords rattle down cobblestone streets. The stock market seems unstoppable, a machine that prints wealth on demand. In just 3 years, prices have doubled. Ordinary workers are now investors. Dinner tables turn into trading desks. Every neighbor has a tip for the next can't-miss stock. Margin accounts flow like champagne. With just $1,000, you can control $10,000 worth of shares. Brokers encourage it. Newspapers celebrate it. The market isn't just a place to invest, it's the fastest way to rewrite your life. But deep under the music, under the flashing lights, a fracture begins to form. Almost no one sees it. Even fewer understand it. The yield curve inverts, just like it does now. Bond traders, those quiet sentinels who move billions in silence, begin shifting into long-term debt, not for profit, but for protection. They aren't reaching for opportunity, they're digging trenches. The headlines then, they could be copied word for word from today. Economy strong, growth unstoppable, experts dismiss recession fears. The front pages tell the crowd to relax, keep buying, trust the prosperity. Meanwhile, hidden deep in the financial section, cryptic warnings appear, tightening credit, shrinking liquidity, strange bond movements. Warnings written in a language almost no one could read. The first cracks don't look like disaster. They look like healthy corrections. Investors rush to buy the dip. Prices bounce. Laughter returns. Champagne pops again. That's the most dangerous part. Markets don't collapse when fear is everywhere. They collapse when faith is absolute. Late October, the floor gives way. Billions in wealth vanish in days. Millionaires in September are broke by November. Banks fail. Businesses shutter. The Great Depression begins. And the parallels to today are not subtle. Our yield curve has been inverted for months, longer than most investors realize. Corporate debt is at record highs. Stocks are priced beyond reason. And yet, the same chorus plays. This time is different. But the data doesn't care about hope. It doesn't listen to optimism. It whispers the same warning it whispered in 1929, in 2000, in 2007. And right now, it's whispering again. You have a choice. Follow the crowd and ignore it, or recognize the pattern and move before they even know it's there. If you're watching and you want to stay ahead of the herd, to catch the next signal before it explodes into headlines, subscribe now. This is where we decode the patterns no one else dares to show you. Because next, we stop talking about history and we start laying today's charts over the ones from 1929, from the dot-com bubble, from the months before the housing collapse. And when those lines match, history stops being a story. It becomes a mirror. The room is dark, not dim, dark. The kind of black that swallows the edges of the walls and makes the silence feel heavier than air. A single monitor glows in the center, casting a cold, pale light across the desk. On its screen, 3 charts wait like silent witnesses, each from a different era, each telling a story that ended in the same kind of ruin. The cursor stirs. With a deliberate click, the first chart fades in. Jagged black lines etched in the grainy texture of old paper. For a moment, it's just history, a relic, harmless. Until a second line appears. It's sharper, red, alive, moving with the pulse of our present. At first, the 2 lines drift apart, wandering like strangers, but as the timeline creeps forward, they draw closer. Peaks align, dips mirror each other. The space between them narrows until they're almost breathing in unison. And then you realize it. The gray line isn't just any chart. It's the Dow Jones from early 1928 to late 1929, the final heartbeat before one of the most infamous collapses in history. And the red line, our market, is tracing its exact footsteps. The cursor clicks again. The background shifts. Now we're in the late 1990s, the Nasdaq during the dot-com bubble. A relentless, euphoric climb driven by the belief that technology had made risk a thing of the past. Every stumble is brushed aside. Just a blip, they said. Then came the reversal, swift, merciless, leaving portfolios gutted in weeks. Overlay today's red line on top, and the match is unsettling. The same climb, the same shallow corrections, the same desperate surges back into the market every time it falters. Different companies, different stories, same blind faith. One more click. Now the S&P 500, 2005 to 2007. Housing prices rocket skyward. Credit gushes into the system. The yield curve inverts, and the few who notice are laughed off as doomsayers. The gray line climbs, hesitates, climbs again, until the floor drops out. 3 decades, 3 economies, 3 different excuses for why the danger doesn't apply this time. And yet, the rhythm is identical. The small declines that lure investors back in, the false rallies that convince them the worst is over before gravity takes over. What's most chilling isn't the crash itself, it's the final rally. That last, intoxicating surge when the crowd is sure the storm has passed. That's exactly where the red line sits, our present. Strip away the headlines, remove the names, the faces, the crises, reduce it all to pure market motion, and the charts become indistinguishable. Human nature hasn't changed in 100 years. We still chase the same highs, we still ignore the same warnings, and we still believe every single time that this time is different. But patterns have patience. They don't bend to optimism. They don't care about our timelines. They wait, silent, predictable, deadly, until the cycle is complete. And right now, the red line is standing exactly where in every previous cycle the fall began. Maybe it happens tomorrow, maybe months from now, but the fingerprint of history is pressed against the glass, and it's an exact match. In the next chapter, we'll stop looking backward. We'll turn to the present, to the fault lines forming under our feet. Because knowing a storm is coming is one thing, but seeing exactly where it will hit first is another entirely. Storms never strike everywhere at once. They find the weakest spots first and tear them open. In the markets, those weak spots are never random. They're the sectors swollen with confidence, drowning in debt, and starved of real liquidity. And right now, those pressure points aren't just under stress, they're groaning. The first fracture, corporate debt. For over a decade, companies have feasted on cheap money, borrowing at near zero rates to fund buybacks, mergers, and endless expansion. It worked flawlessly, as long as borrowing stayed cheap. But that age is over. The refinancing cycle has arrived, and the cost of rolling that debt has doubled, even tripled. Cash flows once seen as untouchable are now being devoured by interest payments. The most leveraged firms, the ones who treated debt like oxygen, will be the first to suffocate. Next, commercial real estate. Look up at the skyline of any major city. Glass towers glitter in the sunlight, but many of them are hollow. Remote work didn't fade. It calcified into a new reality. Landlords are sitting on billions in loans tied to properties bleeding value quarter after quarter. The math only works as long as tenants stay and rents flow. But when occupancy sinks far enough, values implode. And the banks holding that paper, especially smaller regional ones, are praying no one pulls the pin. Then there's the crown jewel, Technology. Every bull market has one. Railroads in the 1920s, dot-coms in 2000, housing in 2007. This time, it's technology. Valuations have soared so far beyond earnings that entire empires now run on belief alone. Right now, that belief is absolute. But history has teeth, and the sectors that fly the highest are always the ones that hit the ground fastest. Beyond US borders, another crack spreads: emerging markets. They gorged on US dollar debt during the cheap money decade. It was easy, plentiful, irresistible. But with the dollar at multi-year highs and global borrowing costs climbing, the repayment burden is turning into a noose. One sovereign default could set off a chain reaction: panic in currency markets, credit freeze, capital flight, the kind of shock that drains entire regions overnight. And then there's the shadow few ever see: derivatives. A vast, tangled web of contracts linking banks, hedge funds, and institutions across the globe. On paper, they transfer risk. In reality, they concentrate it. In calm markets, they print near magical returns. But in crisis, they act like accelerants, multiplying losses, triggering obligations, and transmitting shocks at the speed of light. The danger isn't just the fragility of these points, it's their interconnection. When one goes, it pulls on the next. Margin calls, fire sales, frozen credit. Liquidity evaporates everywhere at once. It's not a slow-motion collapse, it's a detonation. And the cruelest part is the moment before it starts is the quietest. Volatility vanishes, headlines turn cheerful, analysts upgrade their forecasts, the air feels still. But ask any sailor, that stillness isn't peace. It's the ocean holding its breath before it swallows the ship. We've seen the historical parallels, we've mapped the weak spots, and now the weight is building. Somewhere in the system, the first fracture is already there. When it gives way, there will be no warning, no countdown, no rescue, just sudden, violent impact. And by the time the public understands what's happening, the damage will already be irreversible. Right now, the markets feel calm. Too calm. We've seen the signal. We've traced its shadow through every major crash in living memory. We've mapped the weak points and watched them strain under the weight. The pieces are all in place, the same pieces we've seen before every collapse that left scars on the global economy. The truth is, crashes don't begin in the chaos. They're born in the stillness, when everyone believes they're safe, when confidence is overflowing, when the ground feels unshakable. That's when it splits. And this might be the last quiet hour before the storm. If you've felt it too, if the pattern is as clear to you now as it is to us, hit the like button so more people can see this before the window closes. And subscribe right now, because when this fracture turns into a break, you will not have time to prepare. The signal is flashing, history is watching, and the clock is already ticking.